Welcome back. I've got Stewart Heath on the line. Stewart, how are you?
I'm doing great, Michael. Thank you so much for having me. Appreciate it.
I appreciate your time and being on the show today. So why don't you share a little bit about you and the work you do, and then we'll jump into the conversation.
So I am a CPA by training. Uh, been licensed for a little over 40 years. Along the way, I got really interested in real estate and real estate investing and did it for myself for a long time. And about 5 years ago, really wanted to start getting into bigger commercial projects, which meant doing it with other people and partners and investors. And so now Harvard Grace Capital, that's what we do. We structure syndicated real estate investments in what we call boring properties. They're stabilized, they're cash flowing when we buy them, and then we professionally manage them and maximize the cash flow out of that. Frankly, I'm having more fun than I've had at any other point in my career. So I love it.
Oh, that's great. Yeah, it's real estate's one of those things we hear a lot of different people say that's where the fun is. We hear all the talk about the stock market and the ups and downs, and there's plenty of coverage when it comes to that. But uh, as I tell people all the time, real estate's one of those things where we haven't quite figured out a way how to live without it. We kind of need it, and it's so just trying to figure out what that looks like is fun, but be investing in it, from there's tax benefits, of course. There's a lot of people go, well, I don't want to be a property manager. I don't want to be a landlord. It's like, no, you don't have to be that.
Right.
That's I want to dive in a little bit more as to, your flavor of it and why it's such a great way to invest for people. Again, this is not investment advice. We're having an investment conversation. Do your own due diligence, people.
Absolutely.
I don't want you coming
Absolutely.
after Stuart or me going, "Hey, you said this, so I, invested all my money into this." It's like we didn't tell you to do that.
Right.
We never did that. No, So why
Yeah.
don't you, let's dive into, syndication because a lot of people go, what does that mean? They think, oh, syndication like a television show. It's like, no, this is different. So I want to share a little bit about that.
Yeah, a syndication's, just a derivative of the word syndicate, which is a fancy word for a group. And all it means is that when I go get an investor, I don't have one investor. I'll have anywhere from 25 to 50 investors on any particular deal. And that group is called a syndicate or a syndication. We break up the investment piece of the deal into individual slivers that are picked up by individual investors. That's all that means. It's really not complicated at all.
Yeah, and I think that's where you get to be a part of it and not, again, not the unplugging toilets and
That's right.
repainting and things like that. It's, just like, and I explain to people this way when I talk to them about, this type of investment option. And it's like, well, I don't want to own property because I have to do that. It's like, okay. And I ask them, do you own stocks in anybody? And like, yeah, we own, we'll pick on Coca-Cola for a minute. It's like,
Right.
okay, are you going down to Atlanta once a week and helping them bottle? No. Well, you're a shareholder, right? Yeah. Well, you're not required to go there and help pour the syrup in the bottles and all of that kind of good stuff. So it's the same thing with this type of
It is
investment.
exactly the same thing. Yes, sir. Good
Yeah,
example.
yeah. So it's a way to leverage something that is we see in most situations. I mean, yeah, there's market adjustments from time to time, but house or apartment complex or other types of properties, the price of them today compared to what they were 20 years ago, I'm going to go out on a limb and say they're higher, which
Yep.
means your ROI or return on investment is going to increase. And you start leveraging into this, and you're basically, I'll use the phrase, you're kind of a fractional investor. You're not buying the whole thing yourself. You're part of a group that or a syndicate that's
Yeah.
doing it, and your organization.
It's really no different than buying stocks. So it's a good example. The only real difference between that and doing real estate is it's not as liquid. You can't turn around and sell it tomorrow, which a lot of people like. but that's also where your volatility comes in. But I think that problem's actually going to get solved here in the next 5 to 6 years too, as they do more tokenization of private deals, and so there will come some liquidity. But I'm not sure that's all going to be good either. So
Yeah, with any type of innovation and opening things up and, leveraging other types of currency units like cryptocurrency, for example, to things like there's the devil's in the details, and sometimes it can get a little out of the ordinary, and we're still sorting all of that stuff out. And I think that's where, people, obviously do your due diligence, leverage things, but make sure that, the backing you have is as solid as it can be, and not based on, oh well, we're going to ride the wave and it's going to go up like this and then we'll do this. It's like, yeah, well, we've seen again with like Bitcoin, for example, that the price of that has dropped, a pretty considerable amount over the last few months, and
right,
people are like, is it going to go back up again? Probably. Will it
probably, yeah,
will it go to the levels that people predict? I would guess maybe. Who knows? It's like,
right.
you're trying to tell me, I mean, the weather people can't predict the weather very accurately anymore with all the computers and stuff. I think they were more accurate when they were using the chalkboard than they are now. I mean, that's just, I'm dating myself a little bit here, but yeah, it's like I think they were a little more accurate, when it comes to that kind of stuff than
Whereas
all the models
back in
now.
those days, yeah, back in those days, they weren't trying to give us a 2 week forecast either. I'm like, why do y'all even try?
Yeah, exactly. And unless you're in San Diego, then that's a safe bet. It's like, yeah,
Right.
yeah, depending on the time of year, oh yeah, it's going to be about 75 and get down to about 67 or 68. Sometimes I think they just change the number a little bit just so it doesn't look like a complete copy paste. But yeah,
Absolutely.
yeah,
Absolutely.
but yeah. So for somebody that wanted, to get involved in something like this, what do you look for in an investor? What type of commitment,
Yeah.
are you aiming for on this? Because I mean, there's always different things out there that you can get involved in and whatnot, and the entry fee, excuse me, can be, quote unquote steep for some people and maybe not for others. But so
Yeah.
what do you look for in an investor when, especially when you're building out these syndicates?
Well, the way we structure our deals, we fall under an exemption rule by offered by the SEC, and it's called Reg D, and then there are rules under that. So we follow under a rule called 506C. That means every single one of our investors has to be verified as an accredited investor, and that allows us to market our offerings to general solicitation. So we can run ads, we can send out blast emails, we can do whatnot, which we typically do. So everybody has to be an accredited investor. So that's as defined by the SEC. It can get complicated, but essentially, you got to have made a couple of $100,000 a year for the last 3 years, or you got to have a net worth of 1 million or more, not including your house. It gets Yeah, it's different if you're doing it with your wife or if you're a trust or whatever. So there's different levels. So for starters, we're looking for what's generally called high net worth individuals, not necessarily the ultra high net worth individuals, but people who can write a 25 or $50,000 check for an investment that they don't need that money to pay kids' tuition next month. And so that's generally what we're looking at. Usually our offering minimum is about $50,000 for a new relationship. I will almost certainly cut that to 25K because to us it's a very long-term thing. We hope that you're going to do other deals with us, and then when we pay you out on this one, you're going to come back and invest some more with us. So 25K is sort of the entry price. I think we're kind of low in this world. And with our deals, you're also going to start getting some immediate cash flow back on a quarterly basis that should, in the first year, be a minimum of 6.5%. Right now, our portfolio average is 13.5% across all of our different deals because they grow every year. And but the first year of our deals, you're going to be in the mid to high single digits on a cash on cash return basis. That's what we define as a Harvard Grace deal. So that's what we're looking for, and people that are looking for recurring cash flow and tax benefits. So on top of getting that cash, you're not going to pay any taxes on that for at least the first 3 years, just at least through depreciation. And I can go into that more detail if you'd like. But those are generally the types of investors that we're looking to connect with.
Well, thank you for mapping that out for us. And diversification is a key thing in investing. And for high net worth people, they're looking at different things to invest in addition to stocks or other commodities or things like that. And real estate is definitely a great play in my opinion. Again, opinion. But yeah, the tax benefit of it is something that a lot of people don't really recognize. And you had mentioned depreciation, and for people that aren't accountants, they may not know what that is, or if they made it through that first accounting class and never went beyond it. I know they covered depreciation because I got a bachelor's degree in accounting. I know the first class was depreciation, some of the year's digits and all those other fun things. Uh, Double declining balance. What was the other ones? I
Straight line, man, straight
Oh,
line.
straight lines. Yeah, that was my go-to. I'm like, why are we bothering with all this stuff? Let's just do a straight line. It's like, oh no, we're gonna do this. It's like, I know you guys doing, yeah, we got Excel now, but why are we doing all these calculations? So just how many years? 7. All right, divide the cost by 7. There you go. Every year, boom, we do the journal entry. Done. Auditors are happy. I'm happy. We're all happy. Let's go. But for those that don't know what that means from a taxation benefit, why don't you explain that a little bit for people?
Yeah, happy to. So depreciation is also just called cost recovery. It means when you buy an asset, whether it's a computer or an office building, you get to take the cost of that and deduct a certain amount of it every year over the predetermined life. Like a computer, it's going to be a 5 year property, so you get to deduct the cost of that computer using a government IRS prescribed table over 5 years. An office building would be 31 and a half years. And so you get to divide that cost of that building over those number of years. But for anybody who's heard the term bonus depreciation and the one big beautiful bill that was I think signed into law on July the 4th, and not that President Trump could ever be accused of being a showman or entertainer. He picked July the 4th to do that. So they reinstated what's called 100% bonus depreciation. So when we started the year, we still had bonus depreciation, but we were at 40% bonus depreciation. And bonus depreciation applies to things that are called personal property. So legally speaking, property is either personal property, which doesn't mean how it's used. It's just personal property or it's real property. It's either real estate or it's personal property. So anything that can be moved around, like a computer, a car, or tables and chairs, those fall in the class of personal property. And if you have that, then you can deduct 100% of the cost of that forever now until Congress changes it again. And so depreciation is really kind of out the window, really, as far as deducting it over its estimated useful life. It's just you buy it this year, you write it off this year. That's now the law of the land for tax purposes. What does that mean for real estate? Because it does 100% bonus depreciation doesn't apply to real estate. Well, the other thing that's in the law, and I was doing this when this was early on, back in the early 2000s, they allow a process called cost segregation. So if I buy a piece of real estate, I can go in there and have an engineer, an architect, or whoever pick out all the pieces of personal property that are a part of that building, whether it's the light fixture or the carpet tiles or the commodes or whatever. And depending on the type, like if you've got a storage unit, you're going to be about 90% personal property. If you've got an office building, you're going to have about 35 to 40% personal property. And so you pay $10 million for your building and it's an office building, say 40% of that. So $4 million of that is going to be subject to bonus depreciation because we can reclassify it as personal property. So that's a $4 million write-off the year you buy it. And that's something that you can do with real estate that you can't do with any other asset class in the world. And that's why the tax advantages are so huge. And that's just one tax advantage of real estate.
Yeah, there's others, and we know, Kiyosaki, talks about them and writes about them in his
Yes.
books and publications and things like
Yep.
that. And, definitely encourage people if they're looking to get into real estate to, explore a variety of different things to get a bolder understanding for yourself. Do your research and
Yes,
things like
absolutely.
that. But again, it's from that standpoint, it's a huge opportunity from tax savings and to be able to get some income without it being subject to heavy taxes or a lot of taxes or any tax depending on the situation, and that's definitely an area where I think a lot of people would be interested in because they're like, wait, I don't want to do something and then get my dividend back, as a lack of a better term, and then be taxed to death on the thing. It's like
Right.
sometimes they go, is it even worth it? And I know some people have to, and they should, work with their financial advisors and
Yes.
accountants to figure out, okay, what is, the best tax play here within the law, of course, and that's why they're there. There are all
Right.
kinds of tax credits. There's R&D tax credits that I talk about. There's all kinds of fun things that people can do to minimize the tax impact, and they're there for a reason. Because ultimately they want the government wants businesses and individuals to reinvest into the infrastructure in real estate and property and manufacturing, you name it. There's just so many different things. The government wants us to do that. That's why they create these tax benefits and tax credits to entice people to do so.
Agreed. Yeah. The real reason that the real estate has all these tax credits is because our government has recognized for a very long time that we are a real estate based economy. You mentioned in early on this we haven't figured out a way to live without it, and I like to say as long as we are physical beings, we're going to need real estate, whether it's housing and stores to shop in. Even though we have Amazon, people enjoy the activity of shopping. Some people do, and so we're going to have restaurants. We're going to have, and all of these are real estate opportunities. And our federal government and usually state governments to follow along, give us all these incentives for people to go out and build real estate and to own real estate because we are a real estate based economy. Sorry to all the tech and crypto guys. We love you too, but we're still a real estate based economy.
Yeah, and even with the Amazons, they still need factories to box all that stuff up. They're not doing it out in a field somewhere. Well,
They,
it might have been a field at one point, but now it's a big
yeah,
factory and warehouse, and
yeah,
there needs to be logistics and supply chain and a place for the delivery vehicles to operate out of. And so, yeah,
absolutely.
real estate's always going to be around,
Yeah,
and it's an opportunity for people to basically divest, or invest in different ways. And this is a great opportunity. So, in closing, anything else you'd like to share as far as some benefits that we haven't talked about, or things that you could see that will be happening over the next couple years. I don't say 5-year plan. My goodness, 5 years ago we didn't know what was going to hit us. So we
that's just true. Yeah.
yeah. So every it's more like 5 minutes as far as something new goes. But anything you
Yeah.
see in the short term horizon that is going, oh, these are some great opportunities that are coming up.
I think there really is, and I talk about how well, this is a real estate based economy, and the core of all of that is housing. And where rooftops go, commercial developments follow. Walmart doesn't come in and plop a new store and then people build houses around it. It's just the opposite. And so, but the problem we're in really for the last 3 years is that housing is kind of locked up. We've had what some people call high interest rates, and they were. I don't think they're particularly high today. But it is, but we're at rates where it's stopping people from being able to move forward. We've just come off of a period of really high inflation, and wages is always the last thing to catch up. And so people aren't really in the position to buy like they were. This cannot stay. Housing is the most cyclical business in the world, probably. And I just feel like it's got to bust wide open pretty soon. And I think sometime in the first half of next year, we're going to see some things happen. Kamala Harris proposed a $25,000 basically down payment assistance for new homeowners. I would not necessarily be surprised to see the Trump administration come up with something simpler. He also floated the idea of 50-year mortgages here a couple of weeks ago, uh, and a lot of people poo-poo the idea. I'm just like, look, I really feel like to the housing market works on the base level, and I think a lot of those people are a couple of $100 a month away from being able to afford the house they want. If a 50-year mortgage does that for them, more power to them, and it sort of gets the machine running. And the average life of a mortgage is 12 years anyway. So you're not going to keep that 50-year mortgage forever. You're going to refinance or you're going to sell that house and move on to something else. So I think there's going to be some log jam breaking sometime, and hopefully we'll start a multi-year housing boom because the demand is there. The demand is everywhere, and all we're doing is enriching the multifamily apartment owners by not allowing people to buy their houses. Not that I'm against multifamily housing owners. I mean, I think that's the queen of commercial real estate, but we're a little out of balance right now, is what I'm trying to say.
Yeah, and development and all kinds of different things. Yeah, it's going to be interesting to see how this all plays out. But yeah, there's definitely a need for housing. There's a complete, generation, if not two, that would love to be able to own a home and currently can't. And that's problematic. I
Yeah.
mean, you're gonna have a mix of people that own and of people that rent, and we've had that, for almost, I don't want to say forever, but a very long time.
Yeah.
And it's definitely skewed another way, and even to the point where there are people that can't even afford to rent. So there has to be, there's going to be some things that will come into play, and I trust that the powers that be will make some things that will help improve the situation, and we'll adjust as we go along. So, love this conversation. Where can people find out more about you and this amazing work you're doing?
Well, thank you. It has been a fun conversation. I would ask people go to our website, harvardgrace.com, and you can find out about our properties. We have some free resources out there for anybody who's looking at doing some what Wall Street calls alternative investing. And I'll just say that real estate's been around longer than Wall Street, so we're not the alternative. But get some of our free resources. I will. If I can. I just got a new book out. If you email me from on the website, I'll send you a free e-copy. Otherwise, you can get that, I think, for like $9 on Amazon. It's about my rules of how we buy real estate, and it's about the mistakes we've made and the lessons we learned from them in 40 years of investing. And just check us out, and you can even book a call with me because my calendar link's on the website. Be happy to talk with anybody anytime.
Awesome. And I'll definitely have that in the show notes and congrats on the book. And I
Thank
highly
you.
encourage people to look at it and read it because it's, it helps to, some of the success stories and the pitfalls I don't remember having to go downstairs to get in this front door when we first looked at this property. What's going on here? It's like,
Right.
it's like, what's that sign over there? It says, oh, former swamp. I don't think it's former. I think it's still here. So
Right.
anyway, thanks so much for your time today. Really appreciate it.
Thank you, Michael. Appreciate you having me.